Good morning or good afternoon, everyone, and welcome to Pzina's webinar, Value and ESG Better Together. My name is Adrian Jackson, and I'm based in London looking after clients. I'm delighted to have the opportunity to chat today with my New York-based colleagues, Caroline Kai and Rachel Siegel. So to set the stage, let's briefly touch on why we chose for today's webinar to talk about why we think there's a synergy between ESG and value investing. A lot of investors have been underexposed to value for some time, and many of those that we talk to want to address that imbalance, but are concerned that doing so will increase their exposure to areas of the market that don't look so good from an ESG perspective. And as ESG becomes a key focus for their clients or their pension scheme members, they're concerned how they can address this apparent conflict. Now, our message today is that there is no real conflict. Investing only in companies that already score well on ESG criteria is fine, but many of these companies are at valuations which seem unsustainable. We think the real opportunity is buying value stocks that maybe don't score so well on ESG, but where there's the opportunity for ESG improvement. And that's for two reasons. Firstly, it can help drive capital appreciation, which, let's be honest, is what we're really here for in the first place. Also, buying these lower rated ESG stocks and being responsible and engaged owners of them and encouraging that score improvement is doing something very positive and powerful and making the world a better place, essentially. So a quick word of introduction to our two speakers today. Caroline joined us in 2004 as a research analyst. And today, Caroline retains some research responsibilities, but is also one of the co-portfolio managers on each of our global, including non-US, emerging markets and European strategies. Rachel Siegel is one of our ESG analysts, having joined the firm in 2019. And Rachel works closely with our wider analyst team on any ESG issues that arise when they're covering a stock, but also takes the lead on some of the thematic ESG research that we do. So maybe a good place to start, if we can, Caroline, is for you to provide a little bit of granularity on why we think, ESG and value aren't at odds with each other, and why we think one actually enhances the other.
Yeah, well, thanks, Adrian. So to answer that question, I think we should start with perhaps an explanation of what ESG means at Pzina. So we, as value investors, really seek to buy good businesses when they are on sale. In our view, it only happens when something negative has impacted the company. That's obvious to everyone. And we see prospect for improvement over time. So there are two key components to being a value investor. One, a low price starting point, because the negative is already discounted and the improvement isn't. Two, patience and a long-term time horizon, because changes and improvements take time. So ESG issues by their nature are usually medium, long-term in time horizon versus short-term and timing driven. And we don't see how anyone can be a value investor actually without having fully considered ESG issues that are material drivers of the outcomes. So when we think about ESG, it's really about the forces that are impacting the longer term and the transitions that these businesses are going through. Remember, in value land, there's always an issue. Otherwise, the companies wouldn't be cheaply valued to start with. It's how the business and management adapt to the changes that matter. And the price you're paying in the event of success and failure that matter in our view. So in that context, we see resolution of controversies, some of which will fall under the ESG banner as naturally appealing to a value investor. This is why we say ESG is an inherent part of value investing, and it makes value better because anything that speaks to the longer term and the future is what value investing as a philosophy is about. So let me maybe pass it on to Rachel to talk a little bit about sort of the negative perception that people have around value within ESG.
Great, thanks, Caroline. And yes, it's certainly true that value does get a bit of a bad reputation when it comes to ESG. And that's really, we think, primarily because of the way that ESG investing has come to be defined in the market, which is really sort of buying the so-called ESG leaders. We would argue that the definition of ESG investing is really more subjective than public opinion would suggest, and buying leaders is only one interpretation of ESG investing, not necessarily the one that actually allows you to have the most impact on society. And for us, ESG investing is really about improvement potential, as Caroline mentioned, in the same way that our investment philosophy is about earnings recovery. We're looking to buy companies that in the present day are undervalued, whether on ESG or traditional financial metrics. And that's with a view that the pain they're experiencing is short-term in nature, and the drivers of earnings, ESG or otherwise, can improve over time. We actually published recently a white paper on this topic that examined it in some detail, looking at the relationship between ESG scores and stock price performance. And in short, the conclusion of that research was that there really is a much stronger relationship between ESG score improvement and stock price performance than there is at between a point in time assessment of ESG credentials of a company and the stock price. And so I think finally, just to wrap this up, one thing that we think is really important is active ownership. If you're going to adopt this type of approach that's predicated on improvement potential, you have to be prepared to be an active owner of the business and develop a trusted relationship with management so that you can have a seat at the table and advocate for change where it's needed.
Okay, that makes a lot of sense to me. But as everyone knows, there are some big societal issues we're having to grapple at the moment. And the one that springs to mind for me is obviously climate change. How do we, maybe Caroline, as value investors, think about industries that are controversial because of the way they contribute towards climate change? And I'm thinking here really kind of obviously energy, utilities, traditional auto manufacturers that we invest in. How do you get comfortable with those sorts of investments?
Yeah, Adrian, that's a great question. So this is probably one of the biggest controversies that we see in the investment community today. And also something that we think is creating some very interesting investment opportunities in the market. I don't think I'm making any bold statement here by saying if the world is to hit net zero by 2050, some of the biggest emitters of carbon will have to dramatically reduce either their output or find ways to make their output products by putting much fewer molecules into the atmosphere. Now, when stated this way, a lot of investors are saying, why would I want to be involved? There's going to be a lot of changes happening to these companies. And we agree, changes are coming to these businesses. However, we think the market is mispricing some of them because the market is not properly analyzing what the range of outcomes actually look like for the specific company or industry. So, and oftentimes market is underappreciating the resilience of an existing player to leverage its strengths and adapt to the new opportunity or environment. So it's in these adaptations that we see actually the biggest societal benefit being delivered when it comes to emission reduction. So take VW, Volkswagen as an example. The world is transitioning to EV and away from ICE. It's a fact. This is a big change for the industry because it has allowed a range of new competitors to come into the marketplace, such as Tesla. On the other hand, VW is not sitting on its hands and sticking to an ICE-only world. It has been investing aggressively into electric vehicles and is coming out with a range of new products. VW will likely sell more EVs than Tesla in 2022. Now, given its existing distribution reach and ability to scale production relatively quickly, VW's EV push will certainly help accelerate the electrification of the transportation sector globally. However, if you look at the valuation of VW, it's less than a quarter that of Tesla's. If you think of it in per vehicle terms, so every car they sell, the market values VW at roughly about $14,000 per vehicle delivered, when it makes somewhere around $2,000 per vehicle. So you're paying 7 times the current earnings of VW. On the other hand, if you look at Tesla, the company's being valued at $780,000 for every single vehicle it delivers. This is not a 5-fold difference; it's a 50-fold difference, effectively in valuation. Yes, Tesla will be delivering more vehicles over the next few years, but it probably won't be 50 times what it's delivering today, because that will imply 40 million units every year, more than half of the global auto demand. It's extremely unlikely that we have one car company that sells 1 out of 2 cars. So we think there's reason for VW's EV business to be of similar profitability as Tesla's, if not better. And then there's the possibility for VW to grow its volume during this period of industry transition. So this is what we see as extremes that are being priced into the market, and where we find some of the traditional controversial industry leaders to be priced at very attractive valuations.
Okay, that's a very interesting stock situation to think about. But how do you think about things at an industry level? For example, when the IEA came out with its report recently, it impacts the whole industry, not just individual companies. What are your thoughts on that?
Yeah, the IEA report, first of all, I would say it's not a prediction. It's really about laying out a scenario. And as the author stated at the beginning of the report, it really lays out a pathway to net zero and is aimed at spurring government actions on climate. If you look at what it actually said in the report, they laid out a scenario under existing and stated policies that are in the markets today. And what you'll see is there will be very little reduction in CO2 emission over the next 30 years. And that's a sharp contrast to the net zero pledges that's already being made by various governments around the world. So more action is clearly needed. Now, on the other hand, even with perfect government coordination globally, strong policy actions and investments, I will just highlight the fact that based on the IEA report, there is about 5 trillion in new energy investment that needs to happen annually by 2030. And this is really in contrast to, I think, around 900 billion in peak capital spending for the oil and gas industry, just as reference. So even under those rapid transition scenarios, they don't envision a very dramatic decline in energy demand until 2030. Now, we do think it's important to note that the IEA report, along with the Dutch court ruling, the recent Dutch court ruling on Royal Dutch Shell, signal that government policy and societal pressure to accelerate the energy transition is very real. So a forward-looking view of the world takes this into account in analyzing energy investments, for instance. One thing that's interesting is one of the things that we think all these pressure will lead to is a much higher probability of higher oil prices in the medium term. So even under rapid transition scenario, there will still be tens of billions of barrels of oil needed over the medium term. And the current investment levels in the industry are simply too low. And there's not going to be enough production to meet even the most conservative medium-term oil demand forecasts. There will likely be shortages of fossil fuel if we don't invest more. So either price has to go up or investments have to go up, with investment increasingly being directed away from traditional energy assets because of the decarbonization pressure, particularly on the publicly traded companies. It likely means higher oil price. Now, we fully recognize that demand decline will likely accelerate when you have a higher oil price. But paradoxically, energy producers like Shell will make more money and generate much more cash flow in that scenario. And it's worth noting, though, this is probably a desirable outcome from a climate perspective. Now, how does that all translate into the investment case for Shell? And for us, the investment case for Shell really boils down to two observations. Shell's reserve life is in the high single digit only. So there's really no conceivable stranded asset risk at Shell because Shell will run out of reserves before the world runs out of demand for oil. So the math on the liquidation value of Shell's reserves is very straightforward. Simply liquidating these reserves at $60 oil price means close to 10% return to investors. The second observation, the cash flow and return characteristics of the new initiatives at Shell are what set the company apart from some of its peers. The transition plan at Shell allows for meaningful payout to shareholders while funding the change needed in the underlying business model in a decarbonized world. And this specific plan works because Shell has built up a base of assets that are cash cows. They have established an integrated gas business that better positions it for the interim period, and Shell's downstream and marketing business provided it with a better starting point versus some of its peers. So in Royal Dutch Shell, we see a company that offers double-digit cash return during the energy transition with upside optionality in a higher oil price scenario. In our view, the best way to really analyze a business undergoing significant ESG-led challenges like Shell is through a combination of bottom-up company specifics and industry thematic frameworks. So let me pass on to Rachel to discuss the frameworks a little bit further.
Great, thanks. As Caroline was alluding to, we have spent some time developing what can be best thought of as industry ESG frameworks. And these are intended to provide a thematic overview of ESG issues that are relevant to a given industry, acknowledging that many ESG issues can obviously impact all companies in a given industry, such as climate transition risk that we've been talking about. And the top-down view that's provided by these frameworks is really meant as a complement to our focus on bottom-up company-specific analysis. And certainly we do continue to think through ESG issues company by company. In addition to these industry-specific frameworks, we've also put some work into thematic ESG research, as Adrian alluded to at the beginning of the discussion. And this is to examine issues that cross-cut companies and industries. A sort of good and relevant example of this was some of the recent work we did to better understand and dimensionalize the concept of net zero for the research team. And so here we were looking at what does net zero really mean? Why does it matter for our investments? What does a good net zero plan look like? And maybe what are some of the pitfalls that we should be aware of when we're examining these company plans? And this was meant to arm the investment analysts with the information that they need to better assess these types of commitments when they're put out by companies and help focus our engagement efforts moving forward. So then coming back to Royal Dutch Shell as an example of how we've applied our thinking around net zero, these thematic and industry frameworks have actually been quite helpful in allowing us to deepen our understanding of Royal Dutch Shell's plans for the energy transition. And in short, we think that Royal Dutch Shell has a robust approach to net zero, balancing capital discipline with the needs of the energy transition, including a commitment to net zero by 2050, which will include scope 1, 2, and 3 emissions. And Shell acknowledges that there is the potential for lower returns from its renewable businesses moving forward, but has sort of talked about several mitigating factors for the business here. So the first is an emphasis on its LNG or liquefied natural gas business, which is an important transition fuel that has the potential to materially lower the carbon footprint of their business versus, for example, oil. Secondly, they do intend to focus on areas of competitive strength for the business, so namely carbon capture and storage and biofuels, where they actually have technical know-how already in the business that's directly applicable to these new types of businesses. And then thirdly, they hope to boost the returns on their renewables by leveraging their marketing and trading operations to help sell multiples of the electricity that it produces. So, obviously, no discussion of Royal Dutch Shell and the energy transition would be complete without referring to the recent Dutch court ruling that Caroline mentioned. For those of you that may not be familiar with this, it's really the mandate by law that Shell increase the pace of its energy transition materially and will be held accountable under the legal framework in the Netherlands. And so when we think about this, it's important to consider a few things. Firstly, it is actually unclear how the ruling will be enforced moving forward, given that a small percentage of profits for Royal Dutch Shell are actually generated in the Netherlands. And it really only becomes a material risk to the business if this type of litigation is to spread to other developed countries. Secondly, this ruling doesn't appear to increase stranded asset risk for the company. As Caroline alluded to earlier, they would either sell the assets or collect the cash, and it really doesn't reduce the transition optionality moving forward. And then finally, we do view this as an event that could actually widen the range of outcomes on the deployment of cash, particularly through M&A, capital investment, et cetera, and therefore could have knock-on effects on profitability. But even with this sort of widened range of outcomes potential, we still see the stock as significantly undervalued, and therefore we maintain confidence in the investment.
Okay, so I raised climate change. We've now talked a lot about E. What about G and S? Maybe starting with you, Caroline.
Sure. So again, for us, ESG is about forces that impact the range of outcomes for a business over the long term. And we examine social and governance issues through those same lenses. So they're addressed in our process the same way we address environmental issues. We try to understand how the controversy translates into specific business outcomes and reflect that in our assessment of the risk and return embedded in a specific situation. And in the industry-specific framework that Rachel mentioned earlier, social and governance issues can be the dominant ones in some industries. And where we see opportunity for improvement, we will engage with management on how they seek to address these issues. I mean, one point to note on social consideration in particular is that it can be highly subjective and nuanced, and the significant variations exist across geographies, for instance. As always, our focus is on materiality. However, we do have a very small set of red flag issues that, regardless of materiality, once identified, we expect management to address them forcefully, expeditiously, or we will exclude the company from our portfolio. Child labor and human trafficking are social issues that fall into that category for us. Rachel, do you want to talk perhaps a couple of examples where we have engaged with management on social issues in particular?
Yes, sounds good. And perhaps actually a good example to start with here would be our investment in Wilmar, which is a leading Asian agribusiness deeply involved in the palm oil supply chain. And as I'm sure many of you listening to this know, the palm oil industry is notoriously controversial and has garnered significant negative media attention for the inherent environmental and social risks that the business faces. And certainly Wilmar was no exception here. Just to maybe briefly touch on the environmental part, though I do want to sort of spend the majority of time touching on the social and governance issues, palm oil is blamed for deforestation and peatland exploitation, and these are very serious allegations. So by no means do we want to diminish this. We have engaged significantly with Wilmar on these issues, but want to just turn to the social side, where we actually, as we made the initial investment, it was interestingly at a time of particular controversy for Wilmar, because Amnesty International had at the time, around 2016, published a very explosive report alleging the systemic use of child labor on plantations run by Wilmar suppliers. And this was something that we obviously took very seriously, and we had many conversations with the Wilmar management team, the chief sustainability officer, to try to better understand these allegations, and also to highlight to senior management the gravity of these issues and the importance that remediating them had to investors like us. And after these conversations and our own independent research, it was our assessment that a lot of what was in the Amnesty report was a little bit intentionally incendiary and not necessarily verifiable facts. Amnesty also appeared to focus on Wilmar, particularly because of its market share and industry-leading position. And while understandable, that somewhat misrepresented Wilmar as the bad actor versus peers, when in reality, what we found was that the complexity of any agribusiness supply chain makes monitoring and compliance sort of an ongoing and incredibly monumental task. And it was our view that Wilmar was taking the appropriate steps, and actually in the course of our engagement with them, they detailed some of the additional steps that they were planning to take. And so, particularly what we were impressed with there was the changes that they proposed to make to their supplier monitoring program. And this included instituting an industry-leading zero tolerance policy for any incidents of verified exploitation in their supply chain, as well as implementing on-the-ground supplier education programs with a credible third party to help ensure that the local workers on these plantations were sort of aware of best practices when it came to labor management issues. And it's also worth mentioning on the social side that palm oil, when done right as an industry, is actually essential for food affordability, which is particularly important in the developing world. And so, with these social issues, it is important to consider the full picture when evaluating the ESG risks facing a company, and not just focus on the areas where there might be risk, but also where the company is providing opportunities for local communities. And then finally, just on the government side, or the governance side rather, Wilmar's an interesting case in the sense that there is a controlling family shareholder, which in some cases might be viewed as a negative from a governance standpoint. But in the case of Wilmar, it was actually our view that the interests of the family were directly aligned with the interests of long-term shareholders. And that was really building the franchise longevity that was top of mind for them and us at the time. And it was this solid corporate governance foundation that actually enabled, in our view, management to take that proactive interest in the management of these ESG risks, because otherwise this could have threatened their own relationships with their suppliers, such as Nestle and Unilever, who have their own, pretty robust sustainability goals to meet. And so, in this sense, ESG really was better for business at Wilmar, and it made sense that addressing the environmental and social risks was really crucial to the earnings recovery for the stock. And actually, we've seen this story play out a little bit in the improvement of Wilmar's third-party ESG score over time, which sort of speaks to that relationship between ESG improvement and stock price performance that we alluded to at the start of the webinar.
Okay, so this all sounds very positive. Caroline, maybe just as we're getting close to the end of our formal comments, maybe you can give some thought to why you think value gets such a bashing when it comes to discussing ESG.
Yeah, a lot of I think comes back to what Rachel was talking about at the start in terms of how ESG has come to be defined in the market. As Rachel pointed out, we think the definition of ESG investing is in fact quite subjective, and the buy the leader idea is just one interpretation of that. Now, even the buy the leader idea is a funny one for me because that assumes there's a consensus in what's considered a leader. When you look at how relatively low correlated ESG ratings are across the different third-party providers, it kind of begs the question, how does the market then agree on what is a leader? We saw some very interesting research from work from empirical partners, where rather than looking at ESG rating or disclosure to define good, bad ESG, they looked at what are the companies that are commonly held by most ESG funds. And what they find is there's a lot more correlation in these so-called, and they find a sort of about 100 companies within the universe that they would call ESG leaders because they are widely held across a range of ESG funds. What's interesting in terms of characteristics of these 100 ESG leaders is they're very much positively correlated with growth and quality factors, and negatively correlated with value factors. And that correlation became supercharged during the pandemic. In fact, that bifurcation of the ESG leaders' return correlation to growth and value are at their widest gap today of what they've studied. So clearly the current prevailing definition of ESG investing has huge overlap with quality growth and very little with value. We're not saying this definition is right or wrong. We're just simply pointing out the asset allocation implication of this definition, as Adrian, that you alluded to earlier. Now, coming back to how we define ESG investing in a value investor context, we think focusing on improvement rather than starting point is certainly a powerful way to practice ESG investing, and it may actually deliver more societal benefits versus simply buying the best. And on that note, we would ask investors not to judge a manager's seriousness about ESG purely based on some portfolio level metrics, such as carbon emission, without taking into account the fact that businesses are dynamic and will change if they believe it's in their interest to do so. So for us at Pzena, one of the key tenets of our value philosophy is really that good businesses and management will adapt over time, and they react to negative developments by restructuring the business and improve their future prospect. And we see ESG improvement as an integral part of what can change and improve at a company. Increasingly, we think investors are actually recognizing this and starting to reward companies for addressing ESG issues in the same way that they have historically rewarded traditional bottom line improvements through restructuring and cost cutting. And given the starting point of low valuations, we see value stocks as offering much more attractive upside from such ESG improvements than highly valued growth quality companies with already high ESG ratings.
Okay, maybe before we move to questions, if you can look to the future, Caroline, maybe just talk us through how you see ESG evolving at Pzena.
Sure. As I said, ESG effort is an integral part of our research process, and it will continue to evolve just as our research is always evolving, and we believe improving over time. Now, it's important to highlight that the core of our research process has not changed over the last 25 years, but we have made improvements to the tools that we use, the way we manage risks, and the frameworks we have to analyze complex business issues. So I see our ESG efforts touching on all these dimensions. ESG considerations translate directly into what's evolving about customer preference and brand image, what's evolving about operating conditions, and what's evolving about capital spending priorities and the disciplines. So these are obviously integral part of business analysis and risk management. Now, to be more specific, we would continue to develop and refine our frameworks for industries, but also issues such as carbon pricing, labor practices, risk management in infrastructure projects, just to name a few, and making sure that we incorporate elements of best practice that makes most sense and that are compatible with our deep value approach. And we think there's room for both. You have seen us publish thought pieces that really try to look at ESG from a value perspective, and we'd like to do more of that. We want to bring more diversity of perspective to the conversations on ESG and be a resource to our clients on the subject of ESG and value. Finally, if there's one message I want everyone to take away today, it's that value and ESG are not only compatible, but really inextricably linked, particularly in cases where ESG contributed to the value opportunity in the first place.
Okay, I think we should close things off there. There are a bunch of questions coming through that I'm going to try and sort through now live and dish out to you two. I'm going to start with Rachel, and if either of you want to defer to the other, please obviously feel free to do so. Rachel, can I start with you, please? Are there any areas that you wouldn't invest in from an ESG perspective? Let's start with that one, please.
Yeah, no, that's a great question. And the short answer is that we do not apply any top-down exclusions to the portfolio for a couple of reasons. So firstly, philosophically, we believe that active ownership is more important than divestment as a tool that investment managers have to encourage companies to make changes. Because if you divest, then what you're really doing is abdicating responsibility and your ability to do anything about whatever the issue was that perhaps caused the concern in the first place. And then secondly, we do think it's very important to judge each situation on its own merits. And that really works both ways. So, for example, I think we all agree that renewable energy is very important for the energy transition. But that's not to say that every company out there should be investing in renewable technology. Companies need to have a competitive advantage or relevant experience to be successful. And this is actually something that we've discussed in great detail with one of our holdings, ENEOS, which is a Japanese energy and mining conglomerate. And our concern there was that what they were proposing to do was to move very heavily into renewable investment without a proven track record of being good stewards with shareholder capital necessarily, and also without a strong competitive advantage in that technology or skills and experience that could be leveraged to the benefit of developing that. And so it really takes company-specific analysis to know the difference between what may be a sound and an unsound transition plan. And that's really what we do spend the time trying to discover for all of our investments. And then maybe just finally, I'll note that we do actually accept client-directed exclusions. And that's because we very much appreciate that our clients may wish to express a particular set of values through their investments. And so we're perfectly happy to sort of layer that on top of their portfolios and make sure that it's a product that they feel comfortable with at the end of the day.
Okay, this one for Caroline, I think. Yes. Caroline, would we sell out of a stock if it failed to deliver on planned ESG improvements?
Yeah, the short answer is yes, assuming those ESG improvements were central to our investment thesis and the upside potential that we see for the company. Now, it's the same answer everyone would expect from us if they ask, would you sell a stock if it fails to deliver on planned restructuring and earnings improvement? So we're really not treating ESG improvement any differently from how we treat other business improvements. Obviously the ideal way to sell out of a stock is that the improvements are realized and it reaches fair value. But in the non-ideal situation where things aren't improving, we would bring a company back in for re-review to examine what has changed with respect to our investment thesis and the trajectory that the company is on. Any issue or set of issues that are responsible for that, including ESG, will be examined in that context. For example, we recently exited a couple of emerging market utility names, China Resource Power and NTPC in India, because we felt the range of outcomes had widened on the topic of climate transition risk. These risks include lower regulated returns for their coal power assets, because those economies no longer feel the need to incentivize coal generation going forward, the potential imposition of carbon pricing and their impact on earnings, and lastly, the desire by management to materially increase their renewable investments with fairly dubious execution record and return records. So overall, the downside risks in these stocks have materially increased relative to our original thesis, and we made the decision to exit as a result.
Okay, thank you. There's a lot of questions coming through. I don't think we're going to get to them all, but we'll try. I'm also trying to find them so I can give you one each in alternate. So this one's for Rachel, I think. Rachel, we have a global approach to investing. So when it comes to governance standards, how do you deal with countries like Japan where standards are low? Someone mentioned Toshiba here. Can you apply a consistent standard to all markets?
Yeah, another great question. So we actually do hold companies in the Japanese market to a consistent standard, particularly as it relates to corporate governance. And one of the areas within that we've been particularly focused on has been board independence, because we actually think that's a very important check and balance on management. And we've been quite vocal in sharing our opinion on these matters, frequently finding ourselves engaging with management, but also escalating our concerns via either written letters or proxy votes or some other method. And what's interesting is we've actually had some pushback from some of the third-party data services that we subscribe to, with them telling us, well, you really should have a different regional approach or policy that reflects the local market conditions. But it's our view that, a standard is a standard. And if we believe something is important for shareholder value creation, then we don't really want to be picking and choosing where we apply that standard. So obviously, we want to be open with the management teams of the companies that we're invested in so that there's no surprises. But we do view it as our role to be pushing for that change. And what's interesting is that the recent revision of the Japanese corporate governance code that was just announced actually does focus a lot on increasing board independence requirements, among some other things. And that really does show that there is a strong direction of travel in the Japanese market that is very much aligned with what we've always believed in and what we've been advocating for.
Okay, I think I've got one here for Caroline. I quite like this one. It comes back to the points I made at the start about how our clients do want to invest in value, but are worried about their clients or their pension scheme members asking about the lower ESG score. So I'll read this out. There's a question in it. It says here, we have recently introduced third-party climate risk monitoring for our public equity portfolios. As Adrian characterizes, our value manager scores worst under the admittedly current state of metrics employed. While accepting it may be possible to offer alternative definitions of ESG investing as a scheme, our third-party stakeholders undoubtedly judge us on the current state. If this is the state of the real world, does it make value investing a tough place to be for investors that are widely exposed to conventional public scrutiny at a time when society is demanding more disclosure from nearly all large institutions? And he goes on to mention that one of his trustees talks about value investing in ESG as hold your nose and hope the smell goes away. Caroline, can you just give maybe some quick comments on that, please?
Yeah, sure. I mean, look, this is something that we struggle as value investors who really think we have ESG products, but the market looks at these third-party metrics and say that doesn't make any sense to us. Look, we think part of that is how ESG investing has come to be defined in the marketplace at this point, and really we believe what we can do is to stick to what we do as a value investor, to focus on these ESG improvements as a unique angle that's available to value investor, and really to put more out there in terms of examples of improvements that have materialized at the companies that we're engaging with, and for lack of a better word, put more thought pieces out there that, as I mentioned earlier, bring a different perspective to ESG investing. there's no really easy answer to the questions that's being raised here. All we can say is what we do observe from the data is a very clear correlation between the current definition of ESG investing and the quality and growth. So I do think part of the conversation is, do you want to have value in your portfolio? And if you do, who are the managers that are fully integrating ESG into their research process? And by the way, are really doing, in our view, having some positive impact on society overall through the improvements in their underlying holdings? It's a fantastic question, and I'm sorry we don't have a very easy answer to that.
Okay. I think that's a good answer, and I've got one here for Rachel. I can keep this back and forth going, I think. Rachel, you made a reference to an ESG white paper. Can you elaborate a bit more on the research and findings, please?
Sure, happy to. So the impetus for this research was really to further our understanding of the utility of ESG scores, and particularly as this relates to positions or issues that our clients have challenged us on. And so we really wanted to embark on a bit of an intellectual exercise, making use of MSCI's ESG ratings. We actually sought to examine really 3 questions. So the first was, are stocks with lower ESG scores cheaper? The second was, is there a relationship between ESG scores and investment performance? And then the third was, is there a relationship between ESG score improvement and investment performance? And so based on our analysis, the initial indications would suggest 3 broad conclusions. So firstly, stocks with lower ESG scores may be marginally cheaper. Secondly, there wasn't that significant of a relationship between a company's ESG score and future investment performance. But finally, and perhaps most interestingly, we did observe a stronger relationship between the ESG score improvement and future investment performance. And that's really, does nicely tie in with some of what we've been talking about here today about how it is that trajectory that a company is on, and not necessarily the starting point that is what we think matters. But for those who are interested to read more about this and see the methodology in more detail, I believe that information is all on our website, where you can also access a podcast where we go over the findings from this research in a bit more detail.
Okay, thank you. This one's for Caroline. In fact, one of the first question was, your live looks good. I'm not too sure what to say to that. Caroline. Caroline stated that the market underappreciates the possibilities high-emitting value companies have to reduce their carbon footprints. But for example, steel manufacturers and cement companies operate in very competitive markets with thin margins. Will they be able to make sound business cases for capital investments in lower carbon production processes?
Yeah, that is a fantastic question. So the answer on cement is unclear at the moment. And by the way, we're not invested in any cement manufacturers at this particular juncture. And the reason for that is there is actually no viable technology that's obvious that will lead to a significant reduction in the carbon emission of the production process. Within steel, the answer is more complicated. But to sort of simplify it, our view is significant government policy action is required to implement some of these new technologies. So a border carbon adjustment tax is necessary in order to have a viable EU steel production base when carbon emission is heavily regulated and carbon pricing does go up dramatically. And absolutely, we think there are risks in that transition. However, this is where the individual company research also comes in, because the starting point is different for every player within the industry. And the balance sheet flexibility, the asset flexibility that exists within a manufacturer's footprint also varies quite dramatically. There is no one-size-fits-all answer for the whole industry. This is where we think research can make a very big difference as relates to the outcome.
Okay, I'm aware of the time. We've got a couple of minutes left. I'm going to wrap things up there so everyone can get on with their day. Thanks, Caroline and Rachel, for taking the time to chat today and hopefully giving our viewers a lot to think about. I think the point about being a good ESG investor isn't just about buying companies that score well on ESG, but maybe focusing on those undervalued companies that don't score so well, where there's the improvement opportunity. And I mentioned at the outset this idea of capital appreciation, and also the personal satisfaction that through engagement and responsible ownership, you are doing something to make the world a better place as an investor. Thank you, Bessie and Francesca, for organising the webinar behind the scenes. It's all gone swimmingly well and all the prep work. Also, thank you to you, our viewers, for taking the time out of your day. Hope you feel it was time well spent. As I again mentioned at the outset, if we didn't get to your question, and I know there was a few that I didn't get to, unfortunately, or there was a point you felt we didn't fully cover, or you want a link to the recording, drop a line to your regular Pzena contact, or there's an email address of london@pzena.com. So for now, enjoy the rest of your day, and thank you.